Yo, what's up, everybody? We're live here with the Holy Macro Show today with Kashop. Got a lot to talk about today in the markets. Basically, we had the Fed meeting this week. We've had a lot of interesting things going on in the markets over the last couple months, basically year to date, between Venezuela, Iran, central banking, Powell, the situations going on with Powell in Congress and Powell and the president. It's been a lot going on, but now we're going to break that all down for you guys today. But also, we want to talk about the bond market. Bonds been getting hit the last couple of weeks. Bond yields have been spiking higher. We'll talk about where that's going to end up and what we're thinking there. And then moving down the list, we also have gold, copper, and oil. Talking about where we're at in the cycle currently. What commodities do we want to be buying? What commodity-based sectors and what stocks do we want to be buying this year currently right now? And then we'll get into oil, energy, what's going on with the gasoline, heating oil, diesel, jet fuel, what's going on with the refiners compared to the producers, compared to the actual oil prices themselves. And we'll talk about that a little bit more today. And then we're going to get into the dollar, the most important piece of the macro landscape year after year. You guys hear me talk about it all the time, but the dollar is always the most important piece to me. So we're going to break that all down for you guys today. Didn't hit it to slideshow, of course. Sorry, guys. But anyways, getting through this. So getting into bonds. So this week is shop. We had Powell. Powell came in here, basically said he's, not fucking leaving once again. Amazing. Very proud of the guy. But he's staying on as a governor. He's going to step down. So what do you think about what his conference was? Not to mention, I thought it was very dovish. His conversation at the end was very dovish for Powell, kind of setting the stage for the new Fed chair to come in. So what did you think about this Fed meeting, Kashop? Do you think this is something that we should have been paying more attention to? Do you think it was a nothing burger? What do you think about it?
So I watched it live and I absolutely loved it. Now, I have had a lot of, nothing nice to say about Powell for a very long time, especially since 2022 when he started his rate hike campaign and just went aggressive on it. So 2021, he says inflation is transitory, and then he's like, "Oh, I was wrong, and I'm going to wreck asset prices by hiking interest rates 75 basis points at a time." And then he pretty much kills the market, and then the AI trade picks up, and the market goes back up. And here's the thing: so after what Powell did in 2022, the market went back up if you measure it by the indices, but if you measure it by a lot of other data points, it continued down. And the reason for that is all Powell really managed to do was fuel an AI bubble. And that's pretty much it. So I have not had anything nice to say about him in a long time. But then once Trump comes into office and says, we are going to destroy central bank independence and make US the new Zimbabwe, I say print, you print. I say cut interest rates, you cut. So that really doesn't work well in the developed world. So, I mean, once you start doing that in the US, then you're going to lose your reserve currency status. Oil is not going to be priced in dollars anymore. So you have a whole host of complications once you go down that path. And Powell stood firm and said no. So Trump started going after the weaker links, or so he thought. So he tried to fire Lisa Cook by trying to find something in her mortgage application which is completely irrelevant to the entire discussion, tries to get the Department of Justice going on Powell and all these shenanigans. And then he tries to get Stephen Miran into that role so that, he can start voting against the Fed decisions and make his vote noted on the minutes. So when Trump started doing all of this, I realized that Powell's going to be in for a fight of his lifetime. And looking at what he said, so as soon as he came into the conference yesterday, he says, I'm not leaving, and I'm not leaving because the DOJ has not dropped this case against me. And I will only leave once I have absolute certainty that I can retire in peace. And that was a very powerful statement. Now, I don't think in the Fed's history I've ever had a situation where someone gives up the chair position and wants to take a back seat and sit back in the board of governors as just another member. So Powell's kind of making history. He's doing it for the right reasons. And I think he needs to succeed at this. I think Trump needs to back off. And as Kevin Walsh said, he has to prove he is not Trump's sock puppet. So those, I think, was exact words, sock puppet. So it's crazy. So it's crazy seeing this all the way from India, looking at the United States and seeing this is where the Fed is going to. So I think Powell's staying on for all the right reasons. And yeah, he's kind of been dovish. So that's why we had the four dissents. So one, of course, is the Uber Dow Miran, who will just dissent for the sake of it because he wants to cut rates to maybe negative 20%, who knows. So the others, they were all dissenting because they wanted the Fed to get hawkish. And maybe Powell didn't want that. Maybe the other governors did not want DOJ investigations opened on them. So maybe they didn't want that. Either way, we got a very dovish FOMC. And I think once wash is confirmed, we will probably continue down that route. So the interesting thing here is looking at what the bond market is saying versus what the Fed is saying. The Fed is pretty much on a print path, and the bond market, as you rightly called it on last week's show. So I think it was a couple of weeks ago where I said, I think 2 years are kind of a long here, and you are like, maybe nothing more than the 3 month T bills. I don't want to be long, even as high as the 2 year. And I was like, maybe 2 years, fine, maybe not the five, not the 10, not anything longer duration. And you were right, Jason. So I think the 2 year, the 10 year, anything long duration, it's getting wrecked. So I think you had the right call on that. There was no counter trend bounce. And after these Fed minutes, I think we are probably not going to get that counter trend bounce because everywhere what we are seeing is the dollar is about to get destroyed. The bond market is about to get destroyed. And we will talk about the yen later. But looking at what's happening in the Japanese yen market, we can clearly see that they are also intervening by selling treasuries. And that's pretty much going to continue because US bonds are so over-owned by the rest of the world. And once they start switching their reserves from gold, from bonds to gold, it's inevitable that US yields keep rising, especially due to the oil shock, especially due to the fact that the Fed doesn't really care about inflation. So all these factors put together, I think we are just going to see yields get absolutely go bonkers, mortgage rates probably go higher. It's going to be a real wrecking ball for the American economy. So I think you had the perfect call on bonds, and I think you had the perfect trade on it last week as well. So I'll give it over to you to talk about that.
Yeah, I mean, for me, it's just we're in this very low volatility period. We don't usually see these types of periods without a big resolution at some point. And if we look at the entire commodity complex, it's kind of pointing to higher yields. Like everything you point to. I mean, if you want to point to energy, you want to point to copper, you want to point to gold. Anything you can possibly look at in the commodities market is continuing to point to higher yields. Globally, yields continue to move higher. Whether you look, Japan's obviously in Weimar Republic territory, so it's just going straight up. And then if we look at we got Japan, we got Germany starting to move higher. We've got Portugal. You look basically through all of Europe, they're all moving higher. Spain's moving higher. I mean, you're basically seeing this across the board, but the only developed nation that it isn't happening in is the United States. Like, I'm going to bet against that. I bet it's going to happen here as well, not to mention with the way inflation looks. So I do think that this is going to continue to be a trade. I think it's, either you buy put options on TLT. You could also do, sell the futures short. TBT is another one. I don't know if that ETF still exists. I'm assuming it does, especially the last few years. It's been really right. So it's a 2x leveraged short on the bond market on the 20-year to 30. So basically inverse TLT. You could trade that as well. But I just think this trade's going to continue. I mean, the primary downtrend is there. I mean, you can't argue against the primary downtrend. Short term, you could say, hey, we've consolidated, there's lower highs, but there's also higher lows. So, but at the same time, if you put that all together in the context of the macro, it basically says no. And thanks, Freely. I'm glad you own TBT. But no, this looks like this is about to head lower. And if you look at copper's been leading the way and kind of telling us where yields are going to end up. Copper broke out last year, and then it's been kind of, hanging on to those highs. well, the bond market hasn't gone anywhere just yet. It's ready to go. It's going to happen pretty soon. And then gold to bonds, we're looking at a interesting relationship. And Kashop, you and I traded through this cycle as well, where gold was moving with the bond market, and that was, people told us that was impossible. Gold doesn't move with the bond market; it does. And usually that's an early cycle thing, and we're usually heading into a more inflationary cycle at that point. Gold and bonds were moving together 2018, 2019. And then basically in 2020, they started to trade together as well for a while. Right as August topped the gold market, also the bond market was near its top around that point too. This is a lower high here. And then we went sideways, sideways, sideways. And then the different relationship kind of showed up where now gold is moving up as bonds are going down. I don't think it's going to affect bonds too much, but you don't want to see real rates get too high. That's going to put a lot of pressure on the gold market going forward. So continue to pay attention to these things. But I do think that we're still set up for the bond market to go a lot lower. I think that this long-term cycle chart really says it all. We're looking at this long-term uptrend in yields all those years. Yields looked great, just moving in this strong uptrend. So it's basically the opposite of bonds. So bonds were trash. Yields continue to move higher, strong uptrend. We hit that high around 82, 81, 82. And then we move into this big downtrend all the way into 2020. Right then when the Fed said, let's put in as much, let's give money to anybody who has a pulse. And then the market or the yields start to move up again. Now we're just kind of sitting at the edifices of this one where this is ready to move higher. And then as this is going to move higher, I think that's going to be kind of an explosive move to start this off. I think that we will probably see some government intervention right after that. But Kashop, what do you think about, will this is the question everybody asks me every week. Will the government intervene in the bond market in the long yields, do an operation twist or something like that? Do you think that that's a possibility anymore with how big the bond market is, the stock market is? What are you thinking about that?
So they are actually kind of intervening. So the Treasury has a Treasury buyback program, which makes absolutely no sense. But what they are actually doing is they are issuing new debt with a shorter maturity, meaning, maybe they issue 2-year debt in order to retire 25-year debt. So what they are doing is they are kind of trying to control the long end of the yield curve, and it's not working. Now, it's not working, and the reason it's not working is because they're doing 15 billion. Now, what happens when they do 150 billion? What happens when they do 500 billion? What happens when they coordinate with the Fed? So, especially once Kevin Walsh comes in as the governor, what happens when they start to coordinate with the Fed and do those big interventions, like what you're seeing with the Japanese yen right now? So, they are intervening big, and it's kind of working in the short term. So, I think we will see the Treasury take the same path along with the Fed. And I think it will look like it's working in the short term. But what it's going to do is, so you have to really Japan is the example for the rest of the world. So, Japan, what they did, the Bank of Japan, when they had their debt deflation episode, when they had their big crisis. So the Bank of Japan just kept printing money, and it now owns something like 7% of the stock market. It owns like maybe 95% of the sovereign debt market. So what that does is everything ends up on the Bank of Japan's balance sheet, and there is no real price discovery. So insurance companies, banks, whoever has to by law, by mandate has to buy this debt, they own it. No one else owns it. So I think if the treasury starts actively intervening in this market, we will sort of, yes, see a price on a screen and it will say US Treasury yield, but it will be like the Norwegian power market, No one's going to trade those contracts because everyone knows, oh, there's no liquidity in it. It's all tightly controlled and there's no point in trying to trade it. So I think if the Fed intervenes too heavily, we get to that point, and maybe they get to that point and they don't care, or maybe they are like, no, we need to keep an active functioning market because treasuries are the collateral, which kind of it's the collateral that drives all trading. So if they decide let's not intervene too much, then I think rates are going to keep going higher regardless of the level of intervention. If they intervene too heavily, then the entire market is going to get irrelevant and the world is going to look very, very different when that happens.
No, I agree. I want to bring another chart up here when I actually get it copied. But I want to talk about the yen. So I'll bring that up, but I'll let you get started. I want to bring up what's going on with the yen. The yen is, on everybody's mind recently. We had big news yesterday. So lay down what's going on with the yen, where you think we're headed with it. You're more tapped into Japan, yen, central banks than just about anybody I know. So what are you thinking with the yen currently?
So I think my long-term target for the yen is 400. And if you look at the long-term chart, you can see why that's the target. So 160 was a psychological level. It was a level that the Bank of Japan, the government really did not want to lose control over. So once the yen got above 160, they intervened and tried to push it down. They pushed it to, I think, 155, and now it's back depreciating again. So yen going up, meaning USD JPY going up, means the yen is depreciating and the dollar is appreciating. So, what's happening is they're really trying hard to hold that 160 level, and they probably have the tools to do it in the short term. But then, of course, there will come a point where it's going to be like a pressure cooker where it just bursts. So we saw something like this. I think it was 2012 when the Swiss National Bank announced that we are not going to allow the Swiss franc to strengthen. We see there is a problem in Europe, and we see there's a lot of safe haven demand for Swiss francs. So what we are going to do is we are going to print unlimited francs and keep buying euros so that the franc does not appreciate. And they kind of succeeded for a while. They took their interest rates negative. They did all of that. And eventually, at one point, it was just like the lid bursting where the market decided, no, we are going to fight the central bank. And they won. And the central bank sat on huge losses on their euro position. And the Swiss franc just appreciated. Now, I think the same dynamic will happen with the Japanese yen, but in reverse. So they're going to keep trying to fight 160, and once that level is passed, it's a quick, easy shot to 400. Now, that sounds really scary. 160 to 400 is more than 50% depreciation. But then everything about Japan is scary. Their debt is staggering. Their demographics are terrible. And if you look at pretty much the entire dynamic there, it's just mind-boggling that this country could get into so much debt and just go Keynesian the whole way without managing the debt problem and somehow still exist as a developed country. So I think what's going to happen is from 160 to 400 is just going to be a really going to be a really quick depreciation, and it's going to be something very unexpected. So right now Japan is sitting on something like 10-11% inflation, and that's crazy for a nation which is used to something like 2% deflation every year. And if you really think about it, like central bankers are scared about deflation, but deflation is actually a way of life. It means you can keep money in the bank and not worry about it losing value tomorrow. So deflation is exactly what you want in a sound money world. It is exactly what you would have, but central bankers are scared of it because governments keep going into debt and debt becomes harder to service in deflation. Now, Japan has so much debt that they wanted to create inflation to sort of inflate the debt away, and they did succeed, but at the cost of the currency is probably going to go to 400. So I think watch the 160 level, and once it gets comfortably above that, you have a straight ride if you want to start shorting the yen. But I don't know if the US is going to allow the yen to just go crazy like that because US kind of needs its allies. That's why they are given UAE the swap lines as well because US really needs to hold on to its allies right now. So we will see how this plays out. But fundamentally, I think Japan is in a really, really tough situation. Inflation is going to skyrocket, the currency is going to depreciate, and it makes like yes, the Nikkei dollar index looks amazing, but even if you are in Japanese stocks, you will want to have allocation outside of Japanese stocks because again, the Bank of Japan is something like 7% of that market. So yeah, they can keep printing, they can keep buying, but what happens if they are forced to stop? or something exogenous happens. So I think even if you are in Japanese stocks, which have gone up something like 75% in dollar terms in a year or so, that it's been an amazing trade, but I would be very cautious at this point and maybe even start thinking of taking profits on that trade right now.
Yes. Um, looking at the yen, and so many people are going to figure out how to trade this thing. It's like this is an ongoing situation that could really just it's going to just continue to kind of booster up the market a little bit as well. But also that money's going to go somewhere, and it could go into more commodities, more inflationary assets. So I do think that's something to keep paying attention to currently. And then if we're looking at the Fed rate, what do you think going forward, Kashop? Do you think we're going to end up lowering rates again? Do you think they're, this is, for me, it's far fetched, but I'd love to know if you have a thought of raising rates. I'm not saying they might I think they need to raise rates at some point. That doesn't mean I think they are going to do so. So, question for you, what do you think's going forward with Warsh coming in? Do you think we have the situation here where now we're going to start to see them start to reverse policy and raise rates, or do you think he is really a puppet currently and he will probably most likely lower rates?
So I think he will try to lower rates and he will probably get the required majority. So all you need is 7 votes to lower rates. So I think they'll get there. What it's going to do is you're going to have to get used to $4 gasoline. So 4, 5 is just going to keep going and there's no stopping it. And the reason for that is both on the supply side, you see production getting cut with the Valero refinery on fire, and pretty much everywhere in the world you see refineries on fire. So you're going to see gasoline at $4, and that's going to pass on through to pretty much everything. So you're going to have massive inflation. At the same time, they're going to cut rates, and the housing market is not going to rebound because, well, people are afraid. People are afraid to spend. People are afraid to spend. And the reason for that is one, they think AI is going to take their jobs. And two, they think that it's at some point, like, you get used to 2% mortgages and you're like, you pay 6%, 7%. And even if you think those rates are going to come down, you're just going to be like, nah, I'm going to wait it out. So I think there are a lot of reasons that Main Street is not going to do well. And if you look at all the consumer surveys, you can pretty much see that. So, what's going to end up happening is it's going to be a very divided vote, but the Fed will cut. And they will cut because, well, at this point, it's pretty clear that they've been politically captured, and Powell's kind of trying to fight it. But it's just one man in a board of 12. So I don't think he's going to get very far. And I think at some point, Trump is just going to be like, go away. And, I don't care. I have control. Just don't, be a thorn on my side. So I think we get to that point, and then it's just balls to the walls money printing. So what we saw during COVID, where they printed something like $1 trillion a day for 10 days straight or something like that. So I think 300, 400 billion a day or something for 10 days straight. So I think we're going to see something like that. And it's going to be massively inflationary, and markets are just going to be like, hey, it's all good because, the S&P is going up. So who cares if oil is at $200, or who cares if copper is at $12? As long as my portfolio is going up, I'm doing fine. And this is something the Austrians talk about. It's called Ludwig von Mises. He coined this term called the crack up boom, where it's like it's the last stage before a hyperinflationary collapse, where everything goes up, but you sort of feel rich because your wages are increasing and your portfolio is also increasing at a faster pace than the inflation that you see. But at some point, it leads into hyperinflation and currency collapse. So I think we are heading there. I'm not saying we are going to get currency collapse right away. Maybe it's a decade away, maybe it's 2 decades away. But I think we are going to go from an inflationary boom to a crack up boom. And that line, I think it's getting very near, and it's a little scary because first you have all these supply side issues, and then you have this money printing issue on top of it. It's just crazy to think about, but that's the market that we are heading into, and that's the market we have to prepare for.
Yeah, I think that's the thing that people are going to have to continue to, like, you can either trade it or not. That's the thing. It's like You can. So the thing with bubbles is like, and anything that's in a strong uptrend, it's like you can either trade it or not. It's like silver. It's like, you can know that that's a bubble. Like, Kashop and I weren't getting on here every week and going, well, silver is now going to be $300 as our next target. We'd never started updating things like that. For me, it was I'm in a trailing stop. We'll see exactly where this ends up. Kashop may have decided to get out on certain fundamental reasons or not. Who knows exactly. But once again, it's more, we're not going to get on here and make huge, crazy predictions about where the bubble can end up. We just know a bubble will move. And also, I want to participate in that. I like to make money in bubbles. Like, I like commodities. That's where you're making your money most of the time, is when there's finally, everybody's getting very, like cocoa. All of a sudden, everybody in the world's asking me about cocoa. There's nobody who's ever asked me in the entire time I've been trading what's going on with the cocoa market. And then a couple of years ago, every single person who didn't know anything about commodities is asking me what's going on with the cocoa market. That's going to happen in those type of environments. And so we want to figure out ways to participate in that. We want to have the ability to trend follow it, get out of it with some cash, or however you're trading it. That's always going to be a lot more important than anything else. And so just there's going to be all these trends that are continually showing up in the market over the next year. I would say, like, be interested in them, get in the things that are the strongest, get in the things that continue to make the most sense to be in. And then, when those trends change, be willing to get out, because that's how you're going to trade well in anything. If we look at gold, copper, and oil, the main reason why I bring this today is just to kind of show what does the world look like if we have, gold all the way up at these highs, if we have copper all the way up at these highs, and then if we have oil and that's hitting new all-time highs. So, what does the world look like with, $150 oil, $200 oil? And I'll pass that to Kashop. What are you thinking here? Oil prices all the way to $150, $200. What do you think the US is doing? What do you think globally is going on? Do you think we're in straight recession? Do you think we're in more of just a heavy inflationary environment, which kind of, like, with growth keeping up with it, which would be insane to me? I'm sure you're going to say no to that. But once again, what are you thinking here?
So let's think about the last inflationary crisis. So whenever you have inflation, everyone loses, except the governments printing up or going into debt. Everyone loses. So in these inflationary episodes, uh, because the petrodollar was so strong, the dollar was actually losing less than other currencies. So if you look at all the currencies that have hyperinflated away, like don't just look at the DXY, or don't just look at the Asian currencies. So there are 200 countries in the world. More than 50 of them are in Africa. So you look at all their currencies, what they did. You look at, all the Eastern European currencies, what they did. So if you look at that, what you will see is the dollar lost a lot of value during previous inflationary episodes, like the 70s is a great example. But thanks to the petrodollar, it did not lose as much as it should have. Now, what's going to happen this time is we are going to see a lot more resource nationalism. Meaning, if let's say oil goes to $150 and Nigeria's like, so Nigeria right now they have the crude oil, they have the refineries, and they have the export terminals. So it's kind of like they hit the jackpot. Now, oil prices go up, they produce the oil, they refine it, and they can sell it to the countries who they favor, or they sell it in the global market. So, what this is going to do is they are going to hold those resources, and they're going to be like, this is the market rate, but some kind of quid pro quo deal, and I will give you this oil, I will give you this gasoline, I will give you this jet fuel that you need in order to have your summer vacation in Europe, which is coming up in July. So you're going to have these country to country deals. So you're going to see the collapse of this globalized world order, which is basically Pax Americana, which benefits all the developed markets where you have this advanced trading infrastructure. So what you're going to see is these countries with all the resources and the entire supply chain, they are going to start dictating terms. And what you're going to see is those currencies will appreciate because, well, it kind of has to. When you look at trade dynamics, those currencies will start to appreciate. Now, the central banks are not just going to say, we are going to prioritize exports and go mercantilist, which is what Asia did, meaning they want to keep the currency low in order to reduce domestic consumption to favor exports. So they are going to be like, we are in a position of strength and we are going to assert it. So we are going to show it geopolitically. We are going to show it in our foreign policy. So we are going to see all these things happen. And South Africa right now, it's a great example of that. So South Africa had its apartheid, and from that it went the completely opposite direction where white farmers were kind of getting destroyed. And now what they have done is they have said they want an independent foreign policy, meaning on any multinational organization, they are going to vote on their own terms. And now they have struck a deal with China wherein their cargo has 0% tariffs. Now, why does South Africa get this favored deal with China? Well, it's all geopolitics. So you're going to start to see these alliances form, and because of these alliances you're going to start to see their currency strengthen. So whoever has the resources during an inflationary boom, they are going to benefit and their currencies are going to benefit. Now this is a net negative for oil consuming countries. It is a net negative for countries which have other stuff but not resources. So let's say you take us has a lot of resources, so it is kind of also going to be a beneficiary of this. But if you look at India, we import pretty much all our oil. So it's going to be tough for us. It's going to be tough for the Southeast Asian countries because they have great manufacturing, but they do not have the resources. Like, yeah, Malaysia's a different country, Vietnam is a different country. So there are dynamics involved. But what you're going to see is broadly the oil consuming nations or the resource consuming nations, they're going to have a little bit of trouble unless they align with the right power blocks, which means basically you're going to see a lot of trade move away from, hey, I want to be US's biggest trading partner, which means I will depreciate my currency against the dollar, to, hey, I want to be China's biggest trading partner, which means I will keep my currency on terms that the Chinese want me to keep them in. So I'm going to start using their system of payment. So I'm going to start using the SIPs, the, if you want to trade with Russia, the SFPS. So all of these things. So you're going to start to see value move away from the US dominated SWIFT system. You're going to see value move away from these global FX markets, and you're going to start to see it benefit all these resource rich countries. And at that point, I really don't know what happens because the world that I have grown up in. So I was born right when the Berlin Wall came down. So the world that I have grown up in is pretty much the Pax Americana world that we know right now. So when this changes, what happens? I don't know. All I know is this is going to be massively bullish commodities and resource producing nations, and that's where I'm looking to be positioned with my portfolio.
Yeah, I think that's the best way to be because I think there's still so much money to be made in this commodities trade. And I think so many people are just going to overlook it and miss it. You know, like they're missing the fact that there is this great trade sitting in front of everybody that nobody wants to pay attention to because it hasn't happened in so many years. And really, it's like it's just happening. You know, 2020 really started the party. Like a lot of people don't really think about that, but 2020 started this whole cycle. The yields chart really shows that really well, but also here's that bottom that happened in the commodities index, which is mainly energy. Went sideways for a few years. Next thing you know, we're moving higher once again now. I think this is just getting started, and I think it's got a lot crazier to go. Looking at December crude oil futures. So if you look at the front month contract, which everybody is, you know, that's not exactly at the highs just yet. However, if you look at December, those are hitting highs. Most of the time when I see the later contracts hitting all-time highs before the earlier contracts, it's usually telling me that the contracts in the front month will probably start to look like this as well. But this is crazy. This is way over the 2022 highs, which was 130 a barrel on the front month contract. So we're already over that in December. Also, the price, as you see, is lower. When those prices are lower, that's usually telling you there's some sort of supply or demand issue happening in that market. Everybody knows that's the Iran situation. But once again, there's a lot of structural things in here telling you that this is much worse than people believe. So I think that this is going to continue. We see it in heating oil futures as well. Heating oil is all the way up here. Sam brought these charts yesterday, so he did a great job bringing these up. But these look great. And so looking at these, heating oil futures all-time high, gasoline all-time high. So this is pretty interesting, and just kind of looking at those markets, it's telling you so much about where you want to be positioned. You want to be positioned in commodity sectors. Really, the base industrial metals and energy are really the things that are taking off the most, and it all really hinges, and the whole cycle always hinges on the dollar. So if we're looking at the dollar here, Kashop, and we're basically seeing the fact that the money supply is actually loosening currently, which is also going to boost up the market a little bit. And so if the money supply is loosening, as well as boosting up the market, as well as we're looking at the energy stocks, commodity stocks also doing better in this type of environment. What are you thinking here about the dollar? Because this is always the biggest component that we have to figure out as macro guys to figure out where we want to be in the trade. So the dollar, that's the yield curve. Here's the chart looking at that breakdown area. If we start to see below, let's say 96.5, I think we're heading 90 pretty quickly. So what are you thinking about the dollar? How should people be positioned to, basically take advantage of this move that's most likely happening? Because structurally, this looks like a downtrend. And then we have a big breakdown here where it just continued to have a false breakout, and then broke down pretty quickly, went sideways into kind of a bear flag continuation pattern. Now it looks like it's trying to break down once again. So what are you thinking about the dollar? Any of your thoughts on that and where people want to be positioned going forward?
So if you are looking at the dollar index, so you're pretty much looking at dollar versus euros, pounds, the yen, and all these other currencies. Now, the yen, I'm bearish on the yen, so I would say that dollar yen, the dollar appreciates. The euro is a really tough call. On the one hand, the euro should benefit because as the world de-dollarizes, it is the natural currency that you should go to because it has the most liquidity outside of the US Treasury market. Europe is your most liquid financial market. So that's where the money should go. But then Europe is very, very energy dependent, and it used to be dependent on Russian energy. Now it is dependent on US energy and flows from various parts of the world. So what does Europe do once the energy crisis worsens? That's the $1 million question. If they are like, hey, we are going to just reverse all these policies we have had in the last 6 years or last decade and just go back to Russian energy. And here's the thing, like everyone says, oh, Ukraine this, Ukraine that, but Russia took Crimea from Ukraine in 2014. And in 2015, Germany signed the deal for Nord Stream 2 pipeline. So did they care back then? Well, not really. So what happened was once the US started sanctioning Nord Stream 2 and they were like, okay, maybe we really have to stop having Russia as our partner and start getting close to the US. So at that point, and of course then the pipeline got destroyed. So all this uh, conversation is for nothing. So once that happened and they became more dependent on the US, they started relying on the US as their bigger trade partner versus Russia. And then Trump comes in and he's like, tariff this, tariff that. And there's a break in the alliance. And now there's a break in NATO because Spain is saying we do not want US warships to go attack Iran from here because, they do not support this war. And that's pretty much the stance being taken by all European countries. Now, if they say that we are going to shift our alliance away from the US and have closer ties with Russia as a way to get Russian energy and re-industrialize Europe, then I think the euro can strengthen massively from here. And everyone looks at SWIFT and they say SWIFT is the international settlement mechanism. They say SWIFT is US controlled, but it is not. So it is only US controlled because most trade happens in dollars. Now, if trade starts moving more towards euros and Chinese yuan, then I think we can see the dollar index take a big hit, never to recover. So it is the answer to what happens to the dollar is what is going to happen to EU politics. Are they going to get closer to to US, or are they going to get closer to Russia? And I think once we know the answer to that question, then we can answer what happens to the dollar. And I think that's pretty much why the dollar is in this trading range because no one knows the answer to that question. So the market is kind of still for now.
Yeah, and I think it's gonna. I mean, either way, I think the answer is lower dollar. I'm gonna just go out there and say it. I do think the dollar's headed lower. There's going to be a lot of catalysts both directions, but I think that the uptrends in the dollar, those catalysts are probably not going to hang on for very long. I think it might bounce. I think we could even see it get all the way up to 102, 103, something like that. It has a big bounce at some point, but I think all those bounces will continue to be short-lived as long as the yield curve stays the way it is, as long as global flows are looking the way they are currently. I think that that's the biggest possibility, but you have to know there's always upside risk, and there's always the possibility of everything changes, which is why I love Kashop's research so much, because it kind of talks about what we need to watch, what we need to continue to look for and pay attention to. So, all right, guys, I want to thank you guys for joining us today. This is Only Macro Show. We are on at 10 a.m. every Friday. So hopefully we see you guys next week. If you guys have any questions, concerns, anything, feel free to hit us up. Also, make sure to give Kashop a follow. If you're not subscribed to the channel, please subscribe. It's a big help to hit that thumbs up button. It helps us get our information out there. And if you know anybody who's struggling in, what to do with their money and how to protect their capital during inflationary environments, definitely, send them this video. It's a free video. It's out there just to put out information to help people figure out how to do that. All right, guys. We'll see you guys next week. Later, guys.
Bye, everyone.